Hello, savvy investors and real estate enthusiasts. Welcome to the channel where we equip you with the know-how to navigate the complex world of commercial real estate development. If you're joining us for the first time, hit that subscribe button and turn on notifications. You won't want to miss a beat in our comprehensive coverage. Today, we're pulling back the curtain on real estate finance, dissecting key concepts and terms to give you a competitive edge. Get ready to demystify the intricate dance of numbers and strategies that drive this industry. Let's jump in. At its core, real estate finance is about securing the funds to purchase, develop, or invest in property. It's a blend of art and science, balancing economic trends, market analysis, and strategic planning. Consider the financial instruments as the tools of the trade. They range from mortgages to mezzanine loans, from equity partnerships to credit lines. Each tool serves a purpose, tailored to the project's phase, the risk appetite, and the financial landscape. Let's delve deeper into equity. Imagine you're looking at a property worth $1 million. As an equity investor, you might put down $200,000 of your own money. You're now a 20% owner with a significant stake in the property's future. If that skyscraper in the skyline triples in value over a decade, your $200,000 could balloon in proportion. That's the allure of equity, the potential for substantial returns. Now let's contrast that with debt. Suppose you're the lender in our skyscraper scenario. You've loaned $800,000 at a 5% interest rate. Unlike equity, your return is capped at that interest rate, but you get paid back before the equity investors see a dime. It's a safer bet, but with a limited upside. Imagine these monopoly houses represent our investment. Equity is like owning the house. Debt is like holding the mortgage. Both can be profitable, but they carry different risks and rewards. As we wade deeper into real estate finance, it's crucial to grasp some key concepts. Consider the loan-to-value LTV ratio. It's a gauge of leverage comparing the loan amount against the property's value. If our skyscraper has a $750,000 loan on that $1 million valuation, we're looking at a 75% LTV ratio. It's a critical metric for lenders assessing the risk of the loan. Now the debt service coverage ratio, or DSCR. Imagine the skyscraper earns $100,000 a year after expenses, and the annual loan payments are $70,000. Our DSCR is about 143. For every dollar of debt, there's 1.43 available to cover it. Lenders love a high DSCR. It means the property's income comfortably covers the debt payments. The cap rate is another cornerstone concept. It's a snapshot of yield, independent of financing. If that skyscraper nets $100,000 annually and is worth $1 million, the cap rate is 10%. A high cap rate can signal higher return, but often comes with higher risk. The internal rate of return, or IRR, is the compass by which investors navigate the profitability of their ventures. It takes into account all cash flows and the time value of money. If you invest $200,000 now and expect to get $500,000 back in 5 years, the IRR would tell you the annual growth rate of that investment. Now let's talk amortization. It's the roadmap for loan repayment. Our $800,000 loan might be spread over 30 years, with a portion of each payment chipping away at the principal and the rest covering interest. As time goes on, more of your payment goes toward reducing the loan balance. Your financing strategy should be as unique as the property you're investing in. For a new development, a construction to permanent loan might fit the bill, providing funds to build and then converting to a traditional mortgage when the tenants move in. But what about risk? That's where due diligence and analysis come in. Seasoned investors study market trends, scrutinize tenancy agreements, and even simulate worst-case scenarios to ensure they're not caught off guard. And let's not forget the plethora of investment vehicles. From buying property directly to investing in a REIT that manages a portfolio of properties. Each path offers different degrees of liquidity, management involvement, and exposure to market ups and downs. As we wrap up, remember these takeaways. 1. Equity offers growth potential, but comes with higher risk. 2. Debt provides more security but limited upside. 3. LTV, DSCR, cap rate, and IRR are your navigational beacons in the financial seas. 4. Amortization schedules are your itineraries, outlining the journey of each loan payment. 5. Your financing strategy should be tailored, much like a bespoke suit, to the project's contours. 6. Risk management isn't just cautious, it's absolutely critical. 7. The investment vehicle you choose should align with your financial goals and operational style. You've just taken a major leap in understanding the nuts and bolts of real estate finance. I hope you've gained valuable insights and feel empowered to navigate your investments with confidence. Until then, stay curious, keep learning, and I'll see you on the next one. Happy investing!